Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is July 3rd, 2025. I am Luna.
I am JPMorgan.
Where should we start?
Well, what immediately jumps out from the last day or so is that shock drop in ADP private payrolls.
Oh yeah, that was big.
The report for June showed the private sector actually lost 33,000 jobs.
A loss, yeah. That's a major negative surprise, especially when, economists were looking for a gain, a decent gain, nearly 100,000 jobs.
Right, and it's the first monthly contraction in, over 2 years?
That's right, over 2 years. So, yeah, significant data point.
So how quickly did markets really digest this unexpected news? Because the reaction was interesting.
Well, what's fascinating here is how the markets reacted. It's that classic bad news is good news thing investors talk about. Basically, the idea is the worse the economy looks in data like this, the stronger the belief that the Federal Reserve has to step in and cut interest rates.
To stimulate things.
Exactly, stimulate growth. And that conviction, it immediately fueled expectations for a rate cut, maybe even as soon as July.
Okay.
The implied probability, it jumped to about 25% just after that ADP release. And this helped boost overall market sentiment, surprisingly.
Sending stocks up.
Yeah, the S&P 500 and the Nasdaq composite hit record highs. The Nasdaq had a particularly strong rebound.
And it wasn't just stocks, was it? We saw other, maybe riskier assets also getting a boost.
That's right. You saw gold prices firming up around $3,349 an ounce.
Okay.
And Bitcoin surged about 3% to hit $108,000. That's its highest in 2 weeks.
Wow, quite a jump for Bitcoin.
Yeah, strong rebound there. It suggests, renewed risk appetite, all kind of on the back of this softer employment news and the potential Fed easing that implies.
But not everything soared. Oil seemed to tell a different story.
Right. Oil eased back, fell to near $67 a barrel. That was more about fundamentals, though a surprise build in U.S. crude inventories and signs of weak gasoline demand.
So different factors at play there.
Exactly. Meanwhile, the 10-year U.S. Treasury yield, it kind of held steady, mid 4.2% range, reflecting, I think, some ongoing uncertainties despite the rate cut hopes.
Interesting. Still quite a bit of uncertainty baked in there.
Yeah, and it's worth noting, while that headline yield was stable, the real yield that's yield adjusted for inflation, it's still near 2%, which, signals inflation-adjusted returns are still pretty solid for bond investors.
Got it. So, okay, it's clear the market is really obsessing over the Fed's next move. But the Fed isn't just looking at U.S. jobs, right? They're not operating in a vacuum.
Absolutely not. Global factors, particularly trade, they play a massive role in the Fed's thinking.
And speaking of global trade, we've seen some big swings there, too. The U.S. dollar has been wobbling near a 32-year low even.
Yeah, quite dramatic moves in the dollar.
But then we saw a slight uptick, and part of that seemed fueled by some optimism on the trade front, something with Vietnam.
That's right. If we connect this to the bigger picture, President Trump announced a preliminary tariff deal with Vietnam. That definitely eased some immediate trade uncertainty.
Okay. What are the details there?
Well, U.S. imports from Vietnam will face a 20% tariff, and goods that are transshipped, basically routed through Vietnam maybe to avoid other tariffs, they'll face 40%.
So still tariffs, but maybe not as bad as some feared.
Exactly, lower than initially threatened. So the market saw it as a relatively positive step, less uncertainty, at least for now.
And this connects back to the Fed, right?
Right.
Because Powell has talked about tariffs.
Directly, yeah. Fed Chair Jerome Powell, he was speaking at an ECB forum, which is, a big stage for central bankers. And he pointed right at tariffs as a key reason for the Fed's cautious stance. He implied that if it weren't for those tariff-driven price pressures and the uncertainty they cause, the Fed would have lowered interest rates by now.
Wow, that's quite explicit.
It is. He reiterated, though, that the Fed is staying data-dependent, making decisions meeting by meeting, but he kept the door open to easing later this year if the data warrants it.
Okay, so given all this, the jobs shock, the market reaction, the trade developments, Powell's comments, what does it all mean for you, our listener? And what should we be watching for next?
Well, the big one, obviously, is the upcoming official U.S. June employment report. All eyes are on that.
But isn't there a risk there? We talk about bad news is good news, but if the jobs report is really weak, couldn't that optimism just flip, turn into deeper recession fears, even with potential Fed cuts?
Absolutely. That's the tightrope walk right now. This government jobs report carries incredibly high stakes.
Okay.
A significantly weak number could, yes, intensify those Fed rate cut expectations, continuing that weird market logic.
Right. However, if the labor market looks too weak, really falling off a cliff, it could very well spark serious concerns about an economic downturn. Sentiment could shift pretty quickly from relief to, well, worry. Beyond the jobs report, anything else critical?
Definitely keep an eye on trade. There's a critical July 9 deadline for other potential trade agreements. That could swing sentiment too.
Okay, so for you, the retail investor listening in, what's the takeaway?
Look, it's a time for both optimism and caution, I'd say. The market's momentum feels strong. But remember, it's largely fueled by expectations of Fed easing.
Right, expectations.
Any disappointment may be a poor jobs report, but no clear Fed signal, or perhaps a breakdown in those trade talks that could trigger quick reversals, especially with holiday-thin trading, which can amplify price swings.
So maybe caution is warranted. Diversification.
Prudence seems wise. Avoiding overconcentration, ensuring portfolios are diversified. Those are generally good strategies, but maybe especially now.
So as we head into the holiday weekend, here's something to think about. Will that official jobs report solidify this bad news is good news narrative, pushing the Fed closer to easing? Or could a truly weak report finally break that logic, shifting sentiment from relief about rate cuts to real fears about recession, turning bad news into, well, just plain bad news?
That's the key question, something to keep in mind as you track the headlines. Enjoy the brief? Please like and subscribe. From equities and bonds to global risk sentiment, we deliver day's key market moves, macro trends, and institutional flows in just 5 minutes. Livestream coming soon. Stay tuned.